As you know, Nedgroup Investments is an investment company with offices in South Africa and in the UK, and it does offer global investment solutions to fund buyers. The Nedgroup Investments Best of Breed Solutions sees us partner with 7 international fund managers. To tell us more, I'm now going to hand over to Nic Andrew, the Executive Head of Nedgroup Investments. Over to you, Nic.
Thanks very much, Tumi, and I appreciate everyone joining us from around the globe. Today I'm going to talk about something very close to my heart because it's something that's been central to our strategy and success over the last 2 decades, and that is the independent boutique premium. Now, to chat about this, it's worth going back to the start, to 2003. When Nedbank was going through a restructure, and my boss at the time, Tom Boardman, who would later become CEO of Nedbank, asked a group of us to reflect with a white piece of paper what we should do with the struggling mutual fund business. And it was a fairly tough conversation to go back to him and to say, actually, we think banks are not optimally suited to own asset managers, and we've got an idea. We think you should outsource all your assets under a pioneering model called Best of Breed. And there were a couple of reasons for this reflection. We had experienced a number of things in the decade before. We had seen challenges around executive remuneration between the financial conglomerates and between the asset managers in those organizations that had resulted in walkouts and suboptimal client outcomes. We'd seen changes in philosophies and changes in process and people as a result of short-term underperformance, often driven by the corporate as opposed to the investment management component. And we're fairly convinced that that was really a recipe for disaster if you were looking for long-term performance. And on the other side, we had seen subscale boutiques really struggle to survive and get sufficient assets post the tech crisis. And so we came up with a relatively simple formula, and that was, we thought that if we could identify really good managers who had an edge and create an environment for them where they were able to flourish and deliver at their best, a bit like allowing a top sports team to really be able to perform on the field by providing all the other support. And we felt we could do that really well. Things like operations and admin and compliance at scale, creating a brand, investing in technology, making sure one understood product development, distribution, etc. That if we could combine those things, that we'd end up with a really good formula that meant that we'd be able to deliver for our clients, and if we could deliver performance for the clients, ultimately a successful model for both the asset manager and ourselves. So 18 years on, I think we still really believe in that philosophy. We've made some mistakes and we've learned along the way, but overall the range has delivered for our clients, and they've rewarded us by trusting us with their assets, and we've seen those grow from about $1 billion to $25 billion. So before I start, I think it's important to explain what do I mean when I say what is a boutique. And I think there are 3 components to a boutique. The first is that it is owner managed. The second is that it is investment focused. So it doesn't offer ancillary financial services. And finally, it must be not too big that it loses its agility. And if one can combine those things, that's what we think and how we identify a boutique. The second thing is, I think that there are some good reasons why not a boutique. If one doesn't have skill, it doesn't matter what structure one operates, one's unlikely to be able to provide performance. Also, there are certain strategies that are well suited for scale. Examples that I can think of would be both cash and passive. But really, I guess the most important argument against boutiques is you want to make sure that your investment manager is willing to invest sufficiently to provide the resources to deliver their investment proposition, and that the key investment individuals are not worried about surviving. And so we feel that there's this real balance or Goldilocks spot where you don't want to be too big on the one side or too small on the other, and how do you find that perfect position? What I'm going to chat now about are the 7 key characteristics that we've helped and learned over the last 2 decades that have helped us identify top performing managers. And absolutely, we look at all the normal quantitative and qualitative things, the people, the process, the philosophy, etc. But these are perhaps things that are less commonly looked at. And the first is alignment of interest. Just as we urge our managers to urge our staff to invest alongside our clients, so we think it'll be good that our managers do the same. And likewise, we like them to have a material equity ownership in their organization, because that really does encourage long-term thinking. The second is an investment focus, or that they are investment-led as opposed to marketing-led. In particular, we don't like to see managers launching lots of fad funds. Vanguard did some great research where they saw that the lower the number of funds that a manager has, the higher the percentage of those funds outperform their benchmarks. And finding an organization that has investment autonomy and low levels of bureaucracy is much more likely to retain top investment talent. The third key element is around flexibility. We like our managers to have both the ability and the willingness to execute active positions. And again, a really good sign here is if managers have been willing to cap various of their strategies, not accept new money to protect existing investors. The fourth characteristic is downside protection. And our team's done some great research looking back over a few decades and identified that a high percentage of outperformance of good managers comes from their ability to protect capital on the downside, somewhere between 2/3 and 75%. And so what we like to interrogate and to understand is managers' approach to portfolio construction, and in particular, that they've considered what happens if their base case doesn't actually realize. The fifth key characteristic is around long-term orientation, both in terms of how they manage the portfolios, which reduces costs and turnover, but also how they manage their businesses, and particularly how they think about multi-generational succession. The sixth one is a slightly softer one, is passion. And we've never found an exceptional manager who isn't obsessed about delivering exceptional long-term performance for their clients. And finally, we like to make sure that our managers are clearly able to articulate their edge and show real conviction in their philosophy. And probably one of the best ways that we found to do this is to go back years and years reading their reports, and particularly looking at them during periods when they didn't perform well. So I reckon the key insights from those 7 characteristics is that there's a much, much higher probability of seeing these characteristics in boutiques than in asset managers who are bigger or part of larger organizations and that aren't owner managed. So those are some of the things we think about. Let me show you how that's worked in reality and how we've gone through it in terms of some of our best of breed managers. So this table really shows our 6 best of breed global managers. These managers manage different strategies from emerging markets to property to asset allocation, and they're based around the world, in Australia, in the United States, and in the UK. And along the top, I've identified each of those characteristics. And you can see by and large that these managers meet those characteristics and that they've largely outperformed over time. Just a few interesting anecdotes is with NS Partners, who we looked for a long time for a great global emerging market manager. And two things that we found difficult was to find a great global emerging market manager who had a really long track record and who had capacity. And you can see in the final column that they manage a relatively small amount of money, so still have that nimbleness that many other great global emerging market managers no longer have. Another interesting example was FPA. We were looking and we partnered with them a decade ago, but when we were looking for them, we really struggled to find a manager who showed great willingness to be flexible in the asset allocation and who protected capital really well. And you can see there on the downside protection that they just participate in 50% of the downside. So that's some of the stuff we've done. There's also some fantastic research that AMG, a company in the US, has done. They looked quite broadly over 20 years using Mercer data. They adjusted for things like survivorship bias, looked at about 5,000 different strategies, and looked at how boutiques versus non-boutiques did. And the first thing that one could see is that across most strategies, that boutiques were able to outperform non-boutiques in these equity mandates. What is also interesting is that they were also able to outperform the indices, but depending on the indices, the level of outperformance varied, and quite significantly more outperformance in areas such as global equity, global emerging market, and small cap mandates, as opposed to larger or mid cap mandates. As one would imagine, not all boutiques outperform. It would be so nice if it is that easy. But what you can see and what we're looking for, and what we believe those 7 characteristics help us do, is really identify the top boutiques. And here you can see if you can identify the top quartile or ideally the top decile of boutique managers, one can really benefit from material outperformance. And then similar to the research that we did and that I talked about earlier around downside protection, one can see that boutiques really do come into their own in volatile markets and outperform even more in those markets than in more benign conditions. So to summarize, and in conclusion, I think that active management is really tough. That top active managers are difficult to identify, that there are characteristics that increase the probability of identifying those, and that independent boutique managers are more likely to exhibit such characteristics. So that if we can combine those characteristics with a partner such as ourselves, which provides the other elements in a best-of-breed partnerships, we think that that formula is a really good formula for success. We think we've been able to prove it over the last 2 decades and look forward to being able to do it going forward. Many thanks, and back to you, Tumi.
Thank you so much for that, Nick.